Okay, hi everyone. Let's take a look at this corporate tax liability problem. It's problem 2-7. The Tally Corporation had a taxable income of $365,000 from operations after all operating costs but before interest charges of $50,000, dividends received of $15,000, dividends paid of $25,000, and income taxes. What is the firm's taxable income? What's its marginal tax rate? What is its tax expense? And what is its after-tax income? And one additional question, what is the average tax rate based on taxable income? All right, let's take a look and see how we would tackle this one. All right, they give us pre-tax operating earnings of $365,000. That's given there. And then we're going to subtract out the interest deduction of $50,000, right? The interest charges of $50,000, okay, because that is a tax deductible item. But then we have to add back dividends received. Well, why do we only have $4,500? Let me slide down and show you A here. Okay, here's what it says. It says for a corporation, 70% of dividends received are excluded from taxes. So therefore, we only have to take 30% of the $15,000. That's where we come up with the $4,500. Now, at that point, we've computed taxable income. Okay, that means income subject to taxes. So the next thing we have to do is figure out what the taxes are. Okay, now you see I've moved the corporate tax rate and put it up here where you can see it. This is from Table 2, and we've got to calculate what that tax liability is. So we take $22,250, which is, the reason we're doing that is our taxable income is $319,500. So we're falling on this row right here between 100 and 335. So we take $22,250, and then we take 39% times any amount over $100,000. So if you follow the math right here, you can see where we're doing it. We've got $22,000, and then I want to just move that little label from getting in the way. Plus $319,500 minus the $100,000, take that times 39%. And when you work out the math, you come up with a tax liability of $107,855. Okay, now in the next step, we're going to calculate the after-tax income. Well, we've calculated taxable income, and we've calculated taxes, right? We came up with the pre-tax income, or taxable income of $319,500, and then we calculated taxes of $107,850, but we're not done yet. And the reason is, for accounting purposes, all of the dividends are still considered in the calculation of net income. That's the dividends received. That's all income from an accounting perspective. So we had 30% of the dividends appearing here. Now we have to add in that 70%, all right? So that's where that 10.5 comes from, and then that's how we come up with net income. Okay, now adjusting the screen again, you can see how we tackle the marginal and the average tax rate. Well, the company's marginal tax rate is 39%. That was this number right here, the 39% that we got from the tax table. Remember, the marginal tax rate is the rate you pay on the next dollar of income or the last dollar of income. That's your marginal tax rate. And the average tax rate is when you take the total tax, in our case $107,855, and you divide it by taxable income. Income subject to tax, $319,500, and we come up with 33.76%. Okay, so hopefully you found this helpful.